Welcome back to the podcast. Don't forget to go to the website at retireyoungaudio.com and leave us a comment. Also, subscribe to the Retire Young podcast at Apple Podcasts, iHeartRadio, and Spotify.
If you're just tuning in, Al was shedding some light on retirement accounts and retirement strategies that the institutions are utilizing. He got into mutual funds, the different fees that come along with them. And now we understand that mutual funds underperform the financial market, or I should say the underlying that it tracks. But also there's inverse ETFs. So there's different ways that investors can participate in up and down markets. The institutions are doing it, but they're not telling the public, or they're not putting people in strategies that profit in down markets, and that's called shorting. So Al, as we get into this last segment here, I want to continue this discussion about retirements, because we do have a lot of listeners that, like I said earlier, that are planning to retire, but also that are retired and just want to continue their same type of lifestyle, but they don't want to have to be glued to a computer screen. And we get into the buy and hold strategy, and that's just buying buying at any price with no plan of gain or loss. Now, there's up markets, there's also down markets, and you ended that last segment. You brought up insurance, and individual investors want to understand how people, or I guess how the institutions are insuring their portfolios, but not telling you that that's possible. First off, explain what the putting insurance on a portfolio, what that really is, and I'm assuming it's a little bit of options.
Mm-hmm. You cannot call State Farm and say, hey, I want to buy an insurance policy on my portfolio. They will have no idea what you're talking about. You can do it, an investor, a trader, and a retiree can do that, whether you're retired or still working, with options. It's a put option. A put is a part of the option family that goes up in value when the underlying asset goes down in value. Institutions use that. Big traders use that. Warren Buffett uses options. And it's just simply a way of making sure that your portfolio value doesn't take a big hit or go down when the assets, when the market is going down, or the assets within a person's retirement account are going down. So that's a great way to protect what a retiree has. Even if you are, as I mentioned, not retired yet, that can be used in your portfolio to make sure that you are protected. Again, it's not just an asset that you can use, that can be used in a down market to prosper, which it can. Those are options, and we don't have enough time to go into all the details. That's why we have classes on options, classes on the individual leverage assets that we talk about, and classes on stock.
Yeah, we introduced a lot of people in those investing classes what options really are.
Correct. And the interesting thing, or the great thing about having access to all of those different assets in education, is that an individual can make a choice based on what's best for them. And it may be options for some people, it may be futures for some people, stock for some people, but having the opportunity to participate in education on all of those different assets is we think is very important. Last week I started to talk about a study dealing with retirement, and you kind of hit on one of the keys there, and that was that a lot of people don't feel comfortable now that they can retire. We talk about a retirement crisis a lot.
Yeah.
This was a study done by Transamerica Center for Retirement Studies. They found that 23% of workers who are either employed or recently unemployed are just not certain that they can retire comfortably following this coronavirus pandemic. And one of the big reasons is that they saw portfolio values go down. Again, protection would have maybe prevented that. But here's the one that I think is really sad and of concern. 22% of the workers that were polled said they have a plan or have already taken a loan or withdrawal from their 401k just to make sure that their bills are paid now. That's going to have a huge impact on what is available when they go into retirement. And there's three things that are really critical in retirement. When you do retire, and now's the time to start working on this, but number one, don't lose what a person has worked so hard for. People work 20, 30, 40 years putting money into something for retirement. A lot of people now are living maybe as many years in retirement as they did while they were working. So what you have when you retire is hugely important to the quality of life that is lived in retirement.
Did you just say hugely?
I say, is that not a word?
I don't know. We have to check that dictionary.
It's very important. Let me just say that. Sometimes I make up words that just seem to fit with what I'm trying to say.
It happens.
But I think everybody knows what I am talking about. So not losing is important, but learning how to generate extra money off of your retirement accounts. If a person has worked 20, 30, 40 years and there's a chunk of money in that 401k or 403b, instead of just drawing it down, why not learn how to use it to generate more cash so you don't have to draw it down or rely on what's in that big chunk of money for paying your bills and for living the life that you want to live.
And that's important, just to understand the institutions are doing something totally different, is pretty typical. I mean, take Warren Buffett, for example. What does he typically tell people to do? He tells people to buy stock.
Yeah, especially stock in companies that he owns.
Exactly, yeah. But remember, he trades a lot with options. I don't know the exact stat, but it was millions of dollars he collected.
$7 or $8 billion a year.
Okay, $7 billion
in options.
In premiums.
Correct.
Yeah, so just understanding that people don't know what the institutions are doing, and we introduce them these different concepts, what the institutions are doing, the Buffetts. Al, I mentioned, Warren Buffett, how he is collecting he said billions, right?
Billions.
$7 billion roughly per year in premiums. Now, he wants volatility in these financial markets for options. That's why he's telling people to buy stock. He needs that volatility. But that's a term that some people don't know. What does volatility really mean?
Well, volatility is typically we look at the VIX as being kind of what we call the fear index. That is the level of volatility of the S&P 500. In other words, what kind of movement is there going to be? Typically, when that VIX index, the volatility index, goes up, the market is going down. When the volatility is high, the cost of options goes up. When volatility is low, the cost of options go down. So the volatility level is part of the decision-making process in whether you are buying or selling an option. If volatility is low and premiums are low, then premium is basically the value of what you pay for or what you get for the option. If it's low, that might be a good time to buy options.
So
when the premium is high, that's a good time to maybe sell options.
So just to clarify that, when institutions are doing that, they're kind of buying at a discount. Is that right?
Well, absolutely. You get really options provide leverage in two ways. It gives you the opportunity to control more shares of something for a smaller amount of money, but also the return, the percent return is greater. Kind of a rule of thumb with options is that if the underlying asset, and what I mean by that is options are traded on something. They can be traded on stock, can be traded on futures. So that's a derivative that the option is trading on.
Okay.
And if the underlying asset is up 10%, the option should be up about 100%. There's that kind of rule of thumb. So you get an advantage both in the amount that you can control, or amount that can be controlled by an option, and then also the percent return.
So Al, that's just we've had a lot of different terms and different terminology here today, and people just don't understand that, but they still want to learn and participate in these financial markets and understand how the institutions trade and invest, and just those different terms that they're using, like shorting, inverse ETFs. Al, these shows go by so fast. We have such a good time doing this on this Retire Young radio show for people worldwide right now. And I think people wait every week for your words of wisdom. And you had some good ones last week, and I know you're not going to let them down this week. Let's hear them.
Well, you know what, Josh? We often hear people that come into these classes saying, gosh, I wish I had done this before. I wish I had done this when I was 21. Well, how about never having to repeat those words? You've already taken the first step. That's listening to the radio show. There's some forward momentum going there. Don't stop now. Take advantage of these free classes. Because first, you need to determine if trading, investing is right for you. And if you decide it is, it's probably because you see the potential for some personal benefit. If that's the case, why would you want to wait?
And the key is, it's not new, it's just different.
Thanks for listening. Don't forget to check out the website at retireyoungaudio.com and leave us a comment.